This is your host Neil Reddy Ray Bala, exploring all elements of the startup world here at Startup Chemistry. So, how did finance happen to you, Abhinav?
I'm talking about 1980s and 1990s, where bulk of the businesses in India were financed by banks, raising capital to the bare minimum required in the initial stages of the business. How much stake does the investors own, and how much stake do you own? All those things, have to be planned, have to be executed well.
And could you throw some light on what kind of terms are sought during these fundraisers from the entrepreneur or from the firm? You are an expert in deal execution. Can you give us some insight into what are the various exits that a company can have?
Last year, the flavor of the season. The defense companies, we don't know what the flavor of the season they're going to be next year. So these parameters decide from a company side, large company willing to acquire you or merge with you to acquire the specific skill set that you develop.
This is your host Neil Reddy Rebala bringing you the second episode of Startup Chemistry's podcast. If you're somebody who's interested in the world of startups and entrepreneurship, do follow and subscribe. Abhinav Jain is a PE industry veteran and someone who carries 15 years of experience in the industry. He's among the few people who has seen two fund cycles in India. He is a general partner at Gaja Capital and a deal execution expert. Let us dive into the episode and get all the insights from Abhinav. Hi Abhinav, welcome to the show. How are you doing?
Very well, Neil. How are you?
I'm doing good. One of the things that I distinctly noticed about you was, like how you've had a very high achieving, consistent track record, being all India topper twice, and that too in highly competitive exams like CA, and then getting into the PE world, which is like highly coveted even among the top MBAs. So, how did finance happen to you, Abhinav? Did you know from the start that you wanted to be in this space, or like what really triggered this?
So, how did finance happen to me? There's a very interesting story behind it, which I love telling everyone. Let me describe this to you. So, my father is a chartered accountant, and he used to work in Mumbai. He started working in Mumbai around 1982, and I would have been 8, 10 year old when I started going to his office. Back in those days in 1990s, when I used to go to this offices in India were not as fancy as they are today. No air conditioners, no lounges, rickety seats, even more traditional laptops and computers. Even I don't think so. Even laptops were there at that point of time, and lots of files here and there. Back in those days of offices, my father used to have an air conditioned office, an air conditioned cabin for himself, a personal computer, and a sofa inside his cabin as well. And my once I asked my father that I want to have an office like this, and what will it take for me to have an office like this? And for some reason, my father ended up telling me that you need to be a chartered accountant to have an office like this, and that stuck with me. This was, I mean, I would say I would have been 8 or 9 year old when this happened, and this stuck with me all along. And I was so fascinated about the whole thing that I started taking interest in finance and commerce to an extent that I would have passed my first tally entry, an accounting entry in my father's office when I was in eighth standard. I mean,
Wow.
so you always heard about stories about Warren Buffett starting to invest at the age of 13. I can say I started doing accounting and finance at the age of 13 or 14 or something like that. So that's been the compounding effect. Having done this now since a very long period of time, finance has always fascinated me. It's my passion in a way. I love numbers. I love doing accounting. I love doing finance and related activities. Something that I can spend days on without a break and something like that. So it can keep me going. I mean that's how finance happened to me. So I mean it was not really an accident for me, but it was something that was growing in me since childhood.
Interesting. That's really interesting to know, Abhinav. So my next question automatically was, how did Gaja happen? But before we go into that, let's introduce Gaja to the audience, and if you could throw some light on what Gaja does, and
Sure.
yeah.
So Gaja is a leading mid-market private equity player in India. Gaja began in 2004-5. Back then, when private equity was just about happening in India, and I think Gaja would be one of the very few early names to have started off in India. It's quite an achievement that Gaja still survives and thrives very well because very few firms of that vintage have survived a long period of time.
Mhm.
We are currently investing from our fourth fund. It's a $300 million fund which is investing into new age digital tech companies. We do growth investing in companies, which is that, I mean, of course, we will discuss this more later. What is a growth investing stage? But we typically invest in companies which have proven their business models and have achieved a certain level of financial maturity before we invest in them. That's what we do, and we are currently investing from our fourth fund among the better playing performing funds in the country right now, and we plan to grow our franchise even more. One of the very few firms where partners and founders have stayed together since inception, and that's our forte.
That's amazing. So, how did Gaja happen to you, Abhinav?
Yeah. So, so Gaja was I was a campus recruit for Gaja. I
Hmm.
joined ISB in 2007-8 batch. I have my 2008 ISB pass out. Gaja Capital was one of the few PE firms on campus to recruit that year. They were just starting off their first institutional fund at that point of time, a second real fund of investing, and they were on campus. I was very excited about interviewing at least with a private equity firm that was more out of eagerness rather than ambition.
Hmm.
For me at that point of time, I actually had a virtual handshake with one of the other large banks in India before interviewing for Gaja Capital to kind of join them. And yeah, after the course is over, but Gaja happened. I think, they flew half their team to Hyderabad to interview the candidates. I think I would have gone within the space of 2 days, 11 rounds of discussion. And I remember, I think, getting an offer at about 10:30 in the night on day zero or day one, whatever they call it, and basically the first day of when you can give offers. And I was glad enough to sign it right there and then. Prior to that, private equity was something that was exploratory for me. I didn't come to ISB to join a private equity industry or something like that. I was at ISB for the fun of it. But things happened. One thing led to another. Again, as I say that, I think I am a product of my processes and the discipline that I've maintained over the years, and that is something that has resulted in whatever I've achieved so far in my life.
Got it, Abhinav. And as you were speaking about that experience, I was reliving my placement days. Nothing as intense or as rigorous as what you went through, but yeah, I totally get it. That's amazing, Abhinav. So, could we also demystify what a P role? What are the various aspects of your job?
Yeah, so I mean, I started off Gaja Capital in a more of a support role, where I was actually also doubling up as their CFO and deal transactions. But over the years now, having grown through various roles, I've been involved in investments, deal evaluations, portfolio management, investor relations, HR. I mean, now it's like a more of a broad based role that any partner in a firm would need to have to do for the firm to grow and for the franchise to grow. So now the role is fairly fair and wide. I have a team under me which is 5 members strong, and they do various roles in their own capacity, and that's what my role now currently entails.
Mhm. Sure. So another thing, Abhinav, that we would love to know is if you could throw some light on like how did the VCP market evolve over the years, right from when you started, where it stands today, and where is it headed, and at this moment, how's it doing? That would be great.
Sure. I think I mean the PVC market has changed substantially over the years, as I've seen now in front of my eyes, having seen our peers, having seen our competitors, and ourselves change. The deal sourcing has changed significantly over the years for us, and I'll explain this in more detail. So before we get into PEVC market as such, we should discuss an era which most of you guys may not be even aware of. Was an era of Indian corporates without the PEVC money, right?
Hmm.
I'm talking about 1980s and 1990s, where bulk of the businesses in India were financed by banks. They were owned by corporate houses, the likes of Tatas, the likes of Birlas, and many more of that nature. And they were being financed. All their finance was to come from banks in the form of loans. Banks were the real financiers of any new project, any new investments, similar to what any new businesses. So they were the ones who were really financing businesses in India, and a
Hmm.
lot of this power was a lot of this opportunities were restricted to a few handful of people in India at that point of time. So back in those days, an average Joe coming out of college in India would never think of becoming an entrepreneur. Their ambition in life was to get a sound job, a job in a decent corporate house or a bank or something like that, and make a career out of it. Nobody would. I mean, one in maybe lakh would think about starting their own businesses, unless of course you had the business background and your family itself, right? That has changed substantially over the years. Okay, the that has changed. So that nature of business has changed significantly now, where businesses now in India have become entrepreneurs plus investors. Investors come in various shape or form, but these are private investors.
Hmm.
These are investors who are risk taking, and these are investors who are not backing large corporates or not backing large business houses, but are backing young Indian entrepreneurs. They are backing a new technology, they are backing a new product, they're backing a new business model, but they are backing something which is more and more entrepreneurial. This is the change that has happened. So cut to 1990, 2000s, the businesses were corporate plus banks, and today they have become entrepreneurs plus VCs slash private investors.
Hmm.
So that's the way business has evolved, or the overall landscape has evolved
Hmm.
in the past 20 years in India, as we see from our lens.
Hmm.
So now let me come to what has happened since 2005 in that sense. I think early 2000s were the real time when venture capital industry started blossoming in India. At least was showing some green shoots.
Hmm.
And by 2005 6, there were a few handful of PE firms also that were operating. And I think Chris Capital and True North were one of the pioneers of initial private equity businesses, which started back in late 1990s or early 2000s. This 2008-9 onwards is when the great financial crisis happened, and post that, in the aftermath of that, when bank capital really changed things and was not available and stuff like that. In the 2 3 years that went by after that is what really started the venture capital industry in India.
Hmm.
There were venture capital investments that were happening, but they were not so far and wide. One key thing that happened was that in 2012, SEBI, the Indian Financial Services Regulator, which manages all the IPOs and the public market investments and the private market investments, came out with what were known as alternate investment fund regulations. These were the first official recognition of the VC industry. We used to have a regime called venture capital fund industry regime at before that, but they were like, I mean, the regulations were not even 3 pages long in that sense. So they were not really focused on this. But in 2012, the regulators decided that alternate investment industry is now becoming serious one, and that is something that they should uh, work towards expanding a bit more. This allowed for a culture of funds to get set up in India, funds to get set up more and more, and many more managers coming onto the forefront of investing in Indian startups. That led to a real proliferation of private investing in India. And what happened was that coupled that with the boom in the tech side that we saw, technology has really liberated the way you can do business in India. You can manage your own business in India. So no longer somebody who is having a shop in let's say Mumbai needs to worry about access to the market in Bangalore. They can just upload it onto one of the e-commerce websites, and there are customers available to them. Imagine this, that if you were to be in a pre-tech era, and many of you may not have even seen that, large firms like HUL, PNG, all these firms would really crowd out the competition from the market by just occupying the shelf space on the retail stores that were available at that point of time. They would just buy out those spaces. So anyone knew a company like Sugar, a company like Mama Earth would never have been able to flourish back in those days. First, they were strapped for capital. Second, they were strapped from business opportunities itself, because so much was the physical nature of the business at that point of time. And if you control the real estate and if you control the space, then you can't do much about it
Right.
as a competitor. That changed substantially as India grew more and more mature digitally. Uh, Creating a brand became much more easier. Creating a business became much more easier because online space was unlimited. Amazon does not put any restriction on the number of catalogs that you want to put on them. They do not put any restrictions on the number of pages they're going to have for, let's say, a shampoo. So anyone can put up their shampoo onto an Amazon website, and let's see how the customers react to it. So that became a very important sea change as how startups grew in India, right? And you had all these companies that started flourishing. People became liberated. They were able to find space to attract Indian customers. Very interestingly, if you see that the companies in the consumer spaces that have come up, you can talk about Mama, you can talk about Boat. All these companies catered to a very underserved market in India,
Mhm.
a market which was about tier 2 and tier 3 India, which was growing in its income levels, but were not being supplied good quality products from the traditional channels uh, of retail. So a Sony headphone was not available in across the stores in Ranchi at one point of time. What did Boat do? Boat basically ensured that at prices which are one third of a Sony headphone, but looking similar, is available to everyone in Ranchi, right? That's what it does, and it created a brand which was online. So this kind of completely changed the landscape. The market completely expanded for these people. On one hand, the digital India was creating, the smart cities were creating network effects. The advent of Geo had a huge impact on the way people were accessing internet in India. Everything was available on their phones, and if you had the product to sell, there were takers across India now. So the market really swelled. And when the market swelled, these players were right up there to serve to that market. And the spending power were increasing across cities in India. And that led to a significant culture of startups. And what happened after that was that we had a prolific year of unicorn creations after the COVID aftermath, and that just created so much of network effect that today if you go to a college and if you speak to about 10 people there in a decent college, they would say, I don't I mean four out of 10 would tell you that they want to start their own business, and which is terrific for India. It's terrific for innovation because these entrepreneurs are going to have come up with new ideas. They are young, they think differently, they are nimble on their thought process, and to couple that to all the ones who are very serious about it, there is a lot of capital available for them to look out for their businesses.
Mhm.
Yeah.
Got it. That's very comprehensive, Abhinav. Thanks for that. And so I could so relate to the boat story that you were mentioning. So it was a difficult time to get any good headphones, earphones back in my college days. So yeah, now it's a very, very different scenario. And of course, thanks to Amazon and other things, Geo, the accessibility is so much better. Um, so yeah, so my takeaway would be, now with the growth and the pipeline so strong, the VC and then the PE is definitely going to get stronger and stronger in the years ahead. So it's looking great, right?
Yes, yes. According to some estimates, Neil, the PVC industry is just at its nascent stage in India right
Mhm.
now and is expected to grow about 5x from where it is by 2030. The PVC industry follows a typical trend. It basically is a business of high income economies,
Mhm.
because in income economies, typically government is the one which kind of has a lot of space of new businesses. Infrastructure is main, railways is serious and stuff like that. So as income levels grow in per capita basis, you see P's and VCs flourishing, because that's where discretionary spend of the population comes into play.
Mhm.
Till a certain level of income level, people are not doing discretionary spends. They are just focused on their foods, rents, and or medical bills. But as the income levels increase, the discretionary spend goes up, which is the real raw material for a lot of PVC investing. The second PVC investing stage is the tech sector. Tech sector also kind of attracts a lot of PVC investing, because tech is something which is so independent and so person driven that if somebody has an idea and the ability to create a tech product, it can be sold, as I said, anywhere across the globe nowadays. So that is also a very fast growing sector, or a fast growing PVC, something that attracts PVC much more.
Got it, Abhinav. And where does the money come from? All the funds that you're raising or you have raised, these are large sums of money, right? Is it FIIs or is it Indian money? Or could you give us some insight into that?
Sure. So Indian money is currently being attracted. It's just beginning to flourish in this space. There are HNIs and institutions who are now coming to the party of the alternate investment funds. Of late, we have seen some commitments being made to alternate investment funds by insurance companies, by banks, by ultra HNIs in India, and family offices. But that still is a very small part of the market right now. The bulk of the money comes from where the capital is in the world, which is US. Right? US is the big brother of all capital activity in the world, and that's where the bulk of the capital comes from into private equity, even in India. So, just to give you some sense, the all the large buyout firms in India which operate, which is like the Blackstones, the KKRs of the world, the Advents of the world, the General Atlantics of the world, they all raise money in US, and so do all the large VC firms like Sequoia, like Axel. All these firms also raise money in US. So all that money comes from US. US has a very sophisticated system of investing in private equity asset class.
Mhm.
Almost all of their endowment funds of universities, the pension plans of local cities, and the insurance companies have a well-defined strategy of investing in private equity. Some part of that money comes to India as well, and that's where a lot of fund houses, a lot of investments get their money from. and that's where right now the bulk of the money lies. We also have investments from some DFIs like International Finance Corporation, which is the investment arm of World Bank, which is a very significant investor in Indian private space. They do it as a portfolio allocation from their global balance sheet. So this is the spectrum of investors. You also have a spectrum of investors who raise capital from US investors, but then distribute it across Asian managers. Managers are something like us who are basically managing investments for private equity or venture capital. Most of these funds have their offices in Hong Kong and Singapore. And these are the firms which basically will pool capital from all the endowment funds in US and then select, let's say, the top 10, 15 managers across China, India, Indonesia, Vietnam, and stuff like that to back them for their fundraisers.
Got it. And Abhinav, I know that you're involved with a lot of startups and other things. You've seen a lot of startups, evolve over the years. But PE world is actually a place where slightly more mature firms come to you and then reach out, or like you invest in them or get involved with them. So how did this connection between startups and you happen?
Sure. So, startups are our supply chain.
Hmm.
We feed on them. So we need a largest ecosystem. A private equity fund typically has an investment ratio of one deal done for 100 deals seen. Okay. So we typically would have seen about 80 to 100 deals before we choose on doing one. That much depth is absolutely necessary for you to figure out the right company that you want to back and as a private equity investor. All these companies come largely from startup ecosystem. These are the companies that are funded by VCs, angel investors, and stuff like that, and typically are in their year 4 or 5 of their inception before they come to a private equity player like us.
Hmm.
So they would have achieved a certain level of revenue, maybe let's say 50 crores, 60 crores, 100 crores. They would have raised maybe up to 30, 40 crores of capital so far. And now the founder is confident enough for that founder to kind of go to the next level of his fundraise and the growth scale because he's set his processes in play. What a private equity does is that looks to convert a business into an organization, and that's what we do. We want to kind of convert that business which is so much focused on a founder into an organization which has a level 2 team, a CFO's office that works very well, an HR policy, an HR team, and many such things that are part and parcel of any large organization. So our focus is to convert this a business that has seen certain traction in the market into a larger organization, which can then lead to becoming one of the more successful investments for any investor.
Got it. Got it, Abhinav. So let's understand the funding journey of a founder or a startup, and let's dive into that a little bit before we get to one of the topics that our viewers and I am personally waiting for. That is hearing about the IPOs and the exits from you. So yeah, before that, how should an entrepreneur plan his funding path, the journey?
So it's a very subjective one, and the founder should be very clear as to how is he gonna kind of fund his business. I would recommend every founder should first think of a sound business plan, which requires minimum amount of capital to be raised in the early stages of business. You've seen examples of companies. I think one of the global examples is what happened to Uber versus what happens to Facebook CEO. Facebook, Mark Zuckerberg was always very clear. He is building a business which should generate revenue, which should generate profits. Whereas Uber was, I mean, in that all the time looking for customers, providing them discounts, providing them incentives to join the platform. So perhaps the value proposition was not as strong as what was in a Facebook story. What that means is that Mark Zuckerberg has much more control of his company even today than what Uber CEO had when he was thrown out of the business. Yeah. So he ended up. So capital became a much more valuable commodity for the business like Uber, whereas business model was much more valuable for a business like Facebook, and that's where the value lies. So it's all about who's creating more value. Is it the investors or is it the founder in the business? So every founder should always think about raising capital to the bare minimum required in the initial stages of the business. I mean, nowadays we see companies where the founders are already less than 25% of the business, uh, even before raising their Series D round, leave alone reaching IPO, which is something that creates significant moral hazard and occupational hazard, I would say, for everyone involved in the business. Because if there is somebody who's giving his 24 by 7 into a business, that person should be completely aligned to be making a lot of money from the work that he's doing rather than working for other set of investors. I mean, there is no doubt that there will be a motivation loss in a scenario like that, because I mean, at the end of the day, he will say, I'm basically slogging for my investors and not for myself. I might as well do something else." So to me, founders should basically focus on uh, creating business models that are robust enough. There are various stages of fundraising that a founder's journey goes through. Typically, an idea is funded by a friend or a family or somebody who trusts you, and that's called seed capital or a Series A round. Seed or a Series A round is basically somebody who's funded your idea. You had an idea which was clear enough, which excited somebody. Most likely these people are somebody whom you had relationship with in the past, and they know you well. They know that you will not run away from with the money, and they are willing to fund your business idea. These are Series A round of investors who basically will make these investments basis the idea that you present to them as a founder. After that comes the venture capital group of investors. Venture capital group of investors can do investments in Series A to B to C to D, and I mean they are all over the place, but essentially in companies which are yet to turn profitable but have an exciting future, something that they are very keen on, a sector that they have taken a call on, that they invest in. Venture capital typically would invest in a company which is seeing revenue growth, is seeing a good traction in the market, but is still unprofitable. The overall business model has not yet achieved profitability or an EBITDA break even situation. So once the business has reached a certain scale and the operating model which makes sense, which can be seen to be generating profits maybe in the near term or is already profitable, that's when private equity players come into play. Private equity players are players who will invest in companies which have a definitive growth path that can be modeled into an Excel file, that can be projected based on a certain performance of the company already existing there, and essentially taking far less risk. The difference between a VC and a PE fund is basically a VC fund typically has a portfolio of about 30 to 35 investments. So what they've done is that, let's say if they've raised 100 rupees, they have invested 3 rupees in each of the companies that they have invested in. So from an overall portfolio perspective, they are less worried about few of them going to absolute zero,
Mhm.
because they believe that some of them will become a complete home run and they will make their entire returns on investments from a few investments. Just to give you some sense, that I think Axel, in the fund from where they invested in Freshworks, I think they made 1.8 times or something, some crazy number of the entire fund from their Freshworks investments, right? I mean, that is to say, that is to cover for everything that they would have done. I'm sure that they had many losses in that portfolio, but just one such idea will give you a home run in the on the overall fund, right? So that's the way the fund works on a VC space. A private equity fund is far more mature. It attracts a different set of investors. It takes a different level of risk. Hence, returns are slightly more moderated, but at the same time, the risk levels are also slightly more, slightly lesser. And to cover for all of this, what happens is that you need to have a very strong case for the company not going to zero, and that's what we need to kind of see as private equity player. We That's why the robustness of the business model is very important for us. The continuity of the business is very important to us. Of course, in our business also a few investments will not do well, but we definitely don't like to see something becoming zero. So that is something that private equity investors are different from what VC investors do. Once you are out of the private equity space and you are a decent company, then you have multitude of options available to you. You can do your company to IPO, you can take your company to a financial large buyout firm, you can sell your company to a strategic investor. That is for a founder to choose and decide how does he want the fund or how does he or she wants the company to eventually work out. And all of these have different layers of nuances that come into play. As they say, there are no free lunches, so everyone comes with their own nuances, conditions attached, and it's a very subjective decision based on what the founders feel is the right way to go about themselves.
Got it. And usually, what are the norms and the valuations at each of these stages? I mean, it can be generalized, but for whatever we could generalize.
So valuations and stages actually change as you grow with your in your investment journey. And as I said, that the angel investor comes at an idea level. A VC investor picks up maybe an operating metrics to value you. So some VC investors might just value a website based on the eyeballs received on a daily basis, or the subscribers being generated on a regular basis, or just the disbursements that you're doing on a monthly basis or something like that. So that's VC level. So you've moved from idea to one level of performance. A VC, a PE investor typically invests you as a multiple of your revenue, which is the revenue that you record in your books, and typically gives you a multiple on that. Anyone beyond that, which is an IPO player or a buyout player or a strategic player, will typically value you on a multiple of your profitability. So that's the ultimate arrival, or that's the ultimate landing point for any business. That when you reach out to the next stage of investors, which is buyout firms, IPOs, or strategics, you have profitability metrics that work well in your system, and and you're able to value your company basis the profitability metrics of your businesses, and at the same time generate enough revenues, returns for your prior investors. So you can see that from an idea at seed stage to profitability at the final stage, that's how the valuation journey moves for any founder or for any business as they grow in their life cycle.
Mhm. Do you think the lines between VC and PE are somewhere blurring? Yes, no to that. What do you think?
See, what is blurring is the ticket size of the VC investments.
Okay.
So that's blurring now. VCs are doing large transactions. They are investing as high as $50 million in companies, and some are even larger for a larger company. And they are all VC risks that they are taking in a way. A private equity guy can invest again between 20 to $50 million, $100 million. But the nature of investing, as I said, the underwriting capability or the underwriting process of any investment decision for VC and PE is very different.
Mhm.
And PE is more focused on the business per se. VC is more focused on the market, and then focused on the founder and its team and the way it's able to execute. We are already focused on how they have executed so far and will they be able to scale.
Mhm.
So a PE firm, so that has not changed for a VP or VC. What they invest into, and as I said, that VC firms have also raised large funds nowadays, so they can do much larger ticket sizes from their fund houses. But at the same time, the ratio of per investment from a fund is not going to change much. They're going to still have a similar range of number of portfolio companies from a VC fund, purely because they are taking higher risks and they need to diversify a lot more in their fund for them to generate returns. Whereas a PE is always having a more concentrated bet. They will never typically go beyond 12 investments in a fund, and they need to have an underwriting case which is very strong for to ensure that the business will not become zero over a period of time.
Mhm. Got it, Abhinav. And could you throw some light on what kind of terms are sought during these fundraisers from the entrepreneur or from the firm?
Yes. So typically, the funds that come in the early stage or are more focused on how the business will be operated and what are the roles and responsibilities of the founders and stuff like that. What is constant across what do you call the entire spectrum of investments from the funding world is exit rights. Everyone takes exit rights at a certain stage from their investee company, and it doesn't change in terms of the principles of it, right from seed to an to a buyout. So you will definitely have a tag along right, which is if the promoter sells, then you have to also be able to sell along with him. You will have a right to call for an IPO or a strategic sale after a certain period of investment. So all these are typically the exit rights that happen that are constant. What changes are, let's say, the governance rights. So the governance rights are slightly lower when it comes to VC and early stage, because the company is a very nascent business. The company is grappling with a lot of their own compliance systems, their own financial controls and stuff like that, and that kind of makes a very big difference to the to the overall company's behavior. But as you grow more and more in the P world, the control and the governance rights really change. And Ps want more and more governance rights. They want director seats on the board. They would want a clear, defined ways in which the MIS is prepared, the monthly distribution of the MIS, the audits and the auditors, independent directors, and stuff like that. So governance rights change as you grow. In a company, VCs are light on governance, PEs are very high on governance, and sometimes high on control as well. VCs are not so high on control of the businesses in the way their AVMs are. Let me explain a bit more about the AVMs. AVMs are essentially affirmative vote matters, which any VC or a PE firm asks for. And basically, the rule is that no founder can do take decisions in this from this list of AVMs which are there without the consent of the investor. So investors do keep tight control on certain strategic line of businesses, activities, and stuff like that to keep a check on the way the business is growing. All these are negative covenants. They are not positive covenants in that sense. They are not the ones that can push an founder to do something, but they can definitely restrict an idea from the founder.
Got it. I have a million questions there to ask you, but then I will park them for the next episode. This deserves a
Yeah.
whole episode by itself. So you've been through multiple IPOs, and you're an expert in deal execution. Can you give us some insight into what are the various exits that a company can have?
Yes. Typically, a company provides exit to its investors through four routes. The four routes are as follows: IPO. which everyone loves to do and be part of. A strategic sale, which is sell to a company in the form of a merger or an acquisition. A financial sale, which is selling the stake of the investors to a financial investor. Uh, and fourth is buyback by the promoter himself.
Mhm.
Promoter buybacks are less common, but promoter buybacks do happen, especially in cases where investors want exit and promoters think that there is an excellent value on the table for them to make in the next 2 3 years. That's when they raise finance to basically fund the buyout of the investor. I think we saw an example of that fairly recently in the past 2 years when Ritesh Agarwal of Oyo bought out some of his investors, raising personal debt in his name. I think he
Mhm.
was very confident about the value of his company, and that's what led to him buying that stake out. Yeah.
Got it. Um, so, could you demystify this a little bit? How does a founder get that capital or the money in to buy back his shares?
No, so I think buying back the shares, there are financiers available these days, whom if you're able to convince on their the value of the company and the exit requirement of the investors, they do provide you financing for a short term. You can repay that financing from the cash flow that you generate from your company, or maybe sometimes from the from the exit process like an IPO, where you can sell your stake to the other investors.
Now that you have listed what are the various exit paths for a firm, Abhinav, could you also share how should a firm choose between these exit paths?
Yes. So, choosing the exit path is a function of two things. One is the nature of the business that the company is in, and second is the founder's own motivation levels vis-a-vis the business.
Mhm.
Founders, an IPO has to be a company which is to be liked by the public market investors. What do public market investors like? Public market investors like companies which are leaders in their own spaces, which are amongst the top three in their sectors of operation. Public market investors like cash flow generating companies.
Mhm.
Public market investors like companies which have a very high capital efficiency ratio, which means what is the return that you're generating on your capital employed. These are the parameters that attract for public market investors. Public market investors are also attracted and swayed by the flavors of the season. And The flavor of the season change. 2 years back, the flavor of the season was tech companies. Last year, the flavor of the season was defense companies. We don't know what the flavor of the season they're going to be next year. So these parameters decide from a company side. But the most important thing in an IPO is for founder to decide whether he is willing to be get married to the company and to the business forever in his life. We are living in a world where startup founders like to do multiple ventures in their entrepreneurial journey. They like to sell their company and move on to a different business. And those companies are the ones that do not find favor in the IPO markets because you're raising public money based on a certain trust, and the promoters are expected to stay along with the company as long as public shareholders are there. So that is something that is very clear as far as IPOs are concerned. For a strategic sale, what is important is what kind of sector are you in. Certain sectors lend themselves well for a strategic sale.
Mhm.
Sectors like pharma, sectors like IT, sector like consumer, which are very deep sectors. And if you're a niche player or a unique player in that market, you will find a large company willing to acquire you or merge with you to acquire the specific skill set that you developed. What could be the uniqueness about your company? Uniqueness about your company could be your customer base. Uniqueness about your customer company could be your product. Uniqueness about your company could be the kind of R&D that you've done or the kind of IPs that you hold. Many of these factors then decide whether you're an attractive strategic player or not. Uh, as far as financial investors are concerned, they like positive, profitable companies. They like to expose themselves to companies which are in upcoming sectors, which are in sunrise sectors. So you got to be in an attractive sector for that kind of an exit, and also you got to be profitable. You got to be able to not raise primary capital and that's when people like to give exit to other investors when the company no longer requires primary capital for their growth purposes.
Got it. And could you also throw some light on how does a founder build towards these exits?
Yes. So, let's say for an IPO planning has to start, in my view, at least 3 years before you want to launch a company to an IPO.
Mhm.
Because you've got to build your company in a certain way if you got to, IPO the company 3 years down the line. How do your financials look like? What is the growth rate? What is your board composition? How are the investor rights being managed right now? How much stake does the investors own, and how much stake do you own? All those things, have to be planned, have to be executed well for IPOs to be successful. And that is something that uh, you know the uh, the IPO markets look for eventually. IPO process itself, after you've discussed and approved it in the boardroom, is almost a 9 to 12 month process for the IPO to be launched and money to be raised. So you got to build that into your process. So that's how IPO is being planned for. As I said, strategics have to be planned in a certain way. Strategic exit needs the company to have some unique characteristic that is important for for somebody like a large player to get attracted towards you. As I said, that you got to be in the right sector, you got to be wooing the right investors, but most importantly, you got to be known in your circles. It's very important if you're building a company to be in a strategic space, then you are known in your circles. Where when I say known in your circle, it means that the founders of the large companies have met you in the past. They trust you, they trust your numbers, they trust your processes, and there is a lot of trust built in. Because the most important thing that a strategic looks for is what he's buying is what he's getting, and there are no hidden cockroaches in the cupboard, and that's very important for any strategic buyer.
Got it. I think that very clearly highlights the differences between the public markets and the private markets too, in a lot of ways. Let us double click on your IPO experience, Abhinav. I know you've been through multiple IPOs, cutting across sectors. So, could you take us through what goes into an IPO planning in a little bit more elaborate manner?
Sure. So IPO planning, the formal IPO planning begins with the decision of the board of directors of your company that we need to, appoint a banker for our IPO process. That's where the formal IPO planning starts. Of course, as I mentioned, that there is a lot more that needs to happen before you reach that stage in the founder's mind and within the company for IPO to be successful. IPO planning involves, meticulously thinking through the entire process. There are multiple processes and multiple stakeholders involved in the whole planning phase and also the execution phase. And what is very important is for the founder to get his story right. The story is the most important part of the IPO in my view. And as we kind of begin marketing your IPO, the story has to come out very clear. Public market investors are not like private market investors who spend days on a transaction. They typically would give you an hours long meeting when you are coming to Bombay for a roadshow, and in that 1 hour you got to convince them to make an investment of 40 crores, 50 crores into your IPO. And that's something that is challenging, but at the same time it's very important that you are able to make a story very clearly. In terms of milestones on IPO, the milestones on the IPO are fairly straightforward in that sense that you got to first work on your DRHP. DRHP is draft red herring prospectus, which has to be uploaded on and given to SEBI for their comments. Preparing the DRHP itself is a 6 to 9 month process typically, and getting that to SEBI after that. Post that, SEBI takes about 3 to 4 months to clear your DRHP, and once the DRHP is clear, then you are given some time to kind of launch your IPO, which the bankers help you figure out.
A lot of process, but sounds really interesting. You were
Yeah,
mentioning about some. Yeah, please go on.
yeah. No, it's a very long process. I was saying, yeah.
Sure. You were mentioning about the stakeholders involved. So, could you also explain who are all the different stakeholders? What is their role in this
Sure. The
process?
most important stakeholder in the entire IPO process, of course, is SEBI
Mhm.
in the process itself. And the second most important, I would say equally important, are the investors. But keeping these two aside, the other people who really help you in your IPO process are your lawyers, are your investment bankers, and your auditors. Bankers are the guys who kind of source investors for you. They know the market. They know the people who are investing in public markets and IPOs. They open the doors for you across these investors. The lawyers are the one who put together the draft ready prospectus. Typically, an IPO process will at least have two lawyer sets: one representing the investment banker, the second representing the company, and it goes through a very rigorous diligence process to an extent that if you're claiming that you are a pass out from IIT Mumbai, then the banker will refuse to write that in the DRHP unless you show him the certificate which he can keep on record that you passed out of IIT Mumbai on that year. So the diligence, everything that goes into the document has to be diligenced and confirmed by backup records. It's a long process. Imagine about 12 to 15 people who are creating a war room in your office, working day in, day out, and trying to close the matter in that sense. So that's a usual IPO DRHP writing process, which goes on for a couple of months at least, if not more. Uh, and the third one is, of course, your auditor. There are specialized auditors who kind of redraft your accounts for DRHP purposes. If you look at a DRHP, a financial statement is a very significant part of the DRHP, and this has to be redone. You can't just print your audited accounts as it is in the DRHP, and you got to redo them as per SEBI's format. So the auditors, there are public market auditors, capital market auditors who help you do that. So these three, in my view, are the ones who really kind of control the process of an IPO. And if you've done your stuff well, then hopefully they get the DRHP done in 3 months' time. Otherwise, it takes more than that. And then you have to kind of work with SEBI to get your IPO cleared.
Got it. Before I ask you my next question, for the benefit of the viewers, could you share the kind of IPO experiences you have had thus far, the companies that you were involved with?
So sure. So far, Gaja Capital has been involved in six IPOs till date. Personally, I've been involved in four of them, and namely Teamly Services, RBL Bank, CL Educate, and Suryoday, a small finance bank. These are the four IPOs that I was personally involved in. And every IPO, let me tell you, is a different process altogether. The challenges are different. The investor set is different. The bankers are different, and you are dealing with a new set of challenges or processes every time you start an IPO process. The issues could be very different from one IPO to another, and you got to find solutions for those as soon as possible.
Got it. So, did a very unique approach evolve over the years for you on how you approach a particular IPO, how you take it forward, or if you could throw some light on your approach of things, your signature way of doing things, would love to
No,
know that.
so I think I get. I typically like to kind of founders to not focus on the process, and my mantra for them is that focus on the storytelling.
Mhm.
Uh, the process be handled by your CFO and the lawyers and the auditors themselves, and I think that is something that we should be very careful about because the process and the diligence involved in the DRHP writing can eat up a lot of your time. It can muddle up a lot of your thought process. A founder gonna somebody is is someone who should spend a lot of time preparing for his IPO roadshows, get his story absolutely right, get the presentation absolutely right, and that focus really makes a big difference as far as IPO marketing is concerned. As I said, that you only typically get 1 hour with an investor for you to convince him that your company is the best company that is approaching the market in the next week.
That's an interesting insight. Abhinav, so what do you think sets apart a successful IPO from the rest? What is a successful IPO in your mind?
Successful IPO is something that has achieved its objectives of, let's say, providing exit to some of the investors, raising capital for the company, at the same time, leaving enough on the table for the IPO investors for them to see reasonable gains in the short term and the long, medium term period after the IPO is completed. I think that is really the success formula for an IPO. You got to be very careful about the way you price your IPO. The last thing that you want is for your IPO price to go below the listing price to go below the IPO price. So you got to be very careful about it, and sometimes mistakes do happen. Thankfully, in Indian public markets, I mean, of the last 200 IPOs that have gone public in the last 10 odd years, about 140 of them have been in the positive territory. So that's a very good ratio in my mind.
Right. That's a good 70%. That's awesome. Let's move away from all the finance talk, the entrepreneurship, and the startup talk. Let's get to know you a little bit more on the personal side. What's your way of unwinding through all this madness, all the strenuous processes?
Yeah, I mean, investing can be a tough business, and you need to find your ways to unwind. For me, the unwinding happens once or twice a month when I take a short break to drive around to nearby places in my hometown, which is in Mumbai. And I love the driving around to the place called Lonavala nearby. That's my ghetto. Or the weekends, I like off-roading. I like doing stuff around there, eat at fancy restaurants and stuff like that, uh, and sometimes even the roadside food. So that's in a way something that I do very regularly. On long weekends, I prefer traveling within India. I love going to places, both religious as well as historical. Something that I enjoy. India has so much history which is unexplored, not known to us, and something that I love, educating myself on. I mean, once in a while I go on a long vacation, which could be international. My son loves watching cricket, and we travel a lot to kind of watch his cricket matches around the world. So that is something also that excites me.
That's really nice hobby to have. Yeah, especially exploring the India side of things. That's of late something that I've been doing too. Some really fantastic places out there for all of us to go visit. Um, any advice to young professionals watching this podcast?
See, I think the more and more I speak with young professionals these days, I find them getting bored with things and wanting to do something else every 2 3 years in their lives. And my only advice to them is that once you have chosen what you want to do in life, show up and do that year on year, day by day, every day. Things do get boring in every profession, so don't get bogged down. You got to show up. I think in life, according to me, survival instincts are more important than killer instincts. I think you got to survive the dull days, you got to survive the bad days, and the good days will come by. I think if you just hang in there, in the sense that that's very important in my, according to me. And I mean, I've always showed up, and that's the mantra that I've followed personally all my life. Typically, the first one to enter the office, last one to go out, and and that's how I've been at least all my life. Yeah.
Got it. We can't wait to have you back for another episode, Abhinav. But until then, any closing comments?
No, I think, I mean, to all the founders out there and to everyone, who's looking to start up this business, young guys, girls, I mean, I would recommend you are living in the best times in India right now. I think there is an excellent ecosystem being developed for you to launch your business, launch your own business. There is a huge market out there in India, which is, bubbling with confidence. I think go out there and go for your entrepreneurial venture that will serve you well, that will serve the country well. We are in a great phase, and we should cash in.
Got it. Thanks for your time, Abhinav. We have some wonderful insights speaking to you. Um, until we meet again, take care.
Thank you.
Thank you for watching the episode with Abhinav today. If you found the conversation helpful and insightful, do like, share, and subscribe to Startup Chemistry.